Okay, so we are going to realize that once you have operations that involve, okay, different currencies, then you have to decide which one of them is your functional currency. You can realize that here in Uganda, where I am working from, we have imports from China, from Saudi Arabia. That's where we get our raw materials from. But we also have customers in Kenya, customers in Rwanda, customers in Congo. So once you have different currencies, then it becomes tricky on which currency you must record. Okay? You must record your transactions. Remember, these are non-financial statements. These are transactions that we are dealing with. So there are two types of currencies. That is the functional currency and the presentation currency. When it comes to functional currency, that is the currency in which we present these transactions. However, the formal definition is a functional currency is the currency of the primary economic environment. You can remember this by using a mnemonic P. So it is the currency of the primary economic environment in which an entity operates. And therefore, given the fact that it talks about primary economic, it implies what currency, okay, dominates the transactions. Of course, once you are in Uganda, in most cases, it has to be the Ugandan shillings. So there are key terms that we should be knowing. That is, what the monetary item is, what a spot rate is, closing rate is, then also something called average rate. We shall look at monetary items and non-monetary items. Okay, for starters, when we talk about monetary items, we are trying to talk about what is the money that you hold, your cash. Okay? Then, are you likely to receive some money? That is your receivables, as well as your payables. That reflects what we call monetary items. We are going to see that the way we treat monetary items is different from how we treat non-monetary items, like assets. If you have your PPE, the way you translate monetary items is way different from how you translate your non-monetary items. Then we have a key definition of spot exchange rate, which is the exchange rate for immediate delivery. If you are to purchase an item on the market, it is sold in Ugandan shillings, but you have dollars. So you move to the exchange rate guys and exchange your dollars to Ugandan shillings. That is the spot rate. It is always used for such transactions that are immediate in nature. However, when it comes to profit or loss, we come in and talk about the average exchange rate. Of course, because of the volatility of the foreign currencies. Okay, so after looking at, after understanding monetary items, then spot exchange rate, because our discussion is going to be filled with this spot exchange rate, then the closing rate. Once I tell you that we are going to exchange the assets, non-monetary assets, I mean monetary assets, all monetary items using closing rate, then you should know that closing rate is always the exchange rate at the end of the reporting period. If the reporting date is 31st December, then the spot rate, the spot rate or the exchange rate on 31st December becomes our closing rate. I've said to talk about average rate when it comes to cases of volatility. Okay, so having seen what a functional currency is, that is the currency of our primary economic environment, a point can come where you have to exchange from a foreign currency to your functional currency. That's when now we are going to apply those different terms: spot exchange rate, closing rate, and average rate. But the standard gives us some factors that we should look at for us to determine what a functional currency is. And Daniel, these factors are going to be important in the question we are going to discuss, okay? I told you the definition is very important. What a functional currency is, the currency of primary economic environment in which an entity operates, and then what are the factors that we should look at for us to determine that this is the functional currency. I've given an example of my employer. We deal with dollars because we have customers who pay us in dollars, right, from Congo, from Sudan, and then also have customers who pay us in Kenyan shillings. We have suppliers to whom we pay dollars. We also pay in dirhams. We also pay in different currencies. So we want to know what should we call our functional currency. Meanwhile, we also have Ugandan shillings. So that is a set of different currencies. But what should we call our primary economic environment currency? That's why now we consider these factors. An entity considers the following factors in determining its functional currency. 1. You look at what is the currency that mainly influences sales prices for goods and services. That is the first thing. In which currency do you mostly sell your goods? This will often be the currency in which sales prices for its goods and services are denominated, and settled. So, Daniel,
Yes, sir.
I've given an example of Kenyan shillings, USD. We have Sudan pounds, and then the Ugandan shillings. What do you think would be the currency where we mostly sell our goods?
I would think
Ugandan shillings. Perfect. So in fact, these are called primary factors. With the primary factors, we look at in which currency do you often sell your goods. Then 2, what is the currency of the country whose competitive forces and regulations mainly determine the sales prices of goods and services? We all remember the forces of demand and supply, not so? So when it comes to Uganda, what is going for any entity that operates in Uganda? What is going to be the competitive forces, the forces of demand and supply that determine the sales prices of our goods? Daniel,
Yes, sir.
do you think if we start invoicing our customers in USD, we can sustain it?
No.
So the market demand will, even our suppliers, okay, they will force us to always invoice in what? In Ugandan shillings. So that is the first 2 conditions. What is the currency that dominates our sales? Then what is the currency that the forces of demand and supply dictate to use. Then secondly, we look at what is the currency in which we pay our labor, material, and other costs of providing services. You look at your prime costs. In which currency do you pay them? Of course, prime costs we have direct labor, the raw material, and other costs of providing, and other direct related what costs. So if you pay, we look at what is the currency in which you mostly sell. I mean, in which you mostly settle your costs. Of course, in Uganda, our laborers are paid in Ugandan shillings. We buy our local purchases using Ugandan shillings. We pay umeme in Ugandan shillings. So we've looked at the selling, the currency of selling prices, the currency of market of first of demand and supply, and then the currency in which we settle our costs. Once these two are not clear, of course, we're going to find questions when the examiner will tell you these guys mostly sell in dollars, but they pay their labor force and raw material, some in dollars, others in maybe pounds. Or they tell you their sales are dominated in USD, but labor cost is paid in pounds. That is a draw. Once the primary factors are not clear, then we move to the secondary factors. Maybe here I can tell you we have primary factors and secondary factors. Secondary factors, primary factors look at, let me ask you guys, we have mainly two financial statements. Daniel, which one and which one? Daniel?
Yes, sir.
We have two financial statements. Which one and which one? The most common ones? Ivan, can you try?
Yes, statement and profit and loss and statement of financial position.
Perfect. When it comes to primary factors, which statement are we talking about?
Statement of profit and loss.
Perfect.
Profit or loss.
Perfect. So the first primary factors are looking at the transactions in the statement of profit or loss. Of course, selling prices, they're affecting your revenue, not so? And then you have the costs. Now, once the primary factors are not sufficient, you move to the secondary factors. When it comes to the secondary factors, we look at the currency in which funds from financing activities are generated. In which currency do you generate your financing sources? If you are to get loans, in which currency do you get your loans? If you are to issue equity, in which currency do you issue your equity? So once the first primary factors are not okay, then you come to secondary factors. And the secondary factors are the currency in which we raise our funds. Then the second one is the currency in which receipts from operating activities are usually retained. So once you have these two factors, you add them to the first two, you evaluate them, and then you use judgment to determine what your functional currency is. That will be the currency of your primary economic environment in which the entity operates. Please make sure that you remember these 4 points and the definition of functional currency, because around 4 marks shall go to this. Aina, is that clear?
Yes.
Okay. Let us move forward. Now we want to report. We want to report foreign currencies. I told you, my dear students, my company or my employer, we deal with Kenyan shillings, we deal with USD, we deal with Sudan pounds, and also the Ugandan shillings. But after evaluating all those factors, we concluded that our functional currency is Ugandan shillings. Now, what do we have to do? Once we receive dollars, we receive pounds, or we have to pay in dollars, we have to pay in pounds. We need exchange, right? So, what are we going to do? At initial recognition, once we want to buy from a supplier on spot rate, we want to buy and pay them, that we have to translate each transaction by applying the spot exchange rate. We just go to the exchange market, those bureau guys, and get to know what is the exchange rate of $1 to Ugandan shilling at the date of transaction. So if you're going to buy, let me say, fuel from Kenya, once you go and exchange Ugandan shillings to Kenyan shillings, that is the spot rate. So at initial recognition, at initial transaction, we use the spot rate to exchange. But we talked about the average rate. Once the examiner talks about volatility, okay, of the exchange rates for that given currency, then you should use what we call average exchange rate. So once the spot rate of the two currencies is very volatile, it changes, then you must consider average exchange rate. Now, how about at the end of the period? When it comes to the end of the period, okay, at the end of each reporting period, we are likely to have some foreign currency assets and liabilities. So what do we have to do? Once you have monetary assets and liabilities in your financial statements, the standard says we have to restate them at the closing rate. We have to, assuming that we have dollars, we always have at the end of the month, which is now our normal reporting period for us, we report monthly, we have dollars. So how should we translate the dollars to Ugandan shillings? We use the closing rate. And we say that the closing rate is always the rate at the end of the reporting period. So when it comes to monetary assets and liabilities, we use, or we restate them at closing rate. We restate them at closing rate. When it comes to non-monetary assets, like the PPE, non-monetary assets, like the non-current assets, these ones we are not supposed to restate. Okay? Do not restate. The reason is we are using historical cost. So if we bought machinery from China, we paid dollars, then our functional currency is Ugandan shillings, we converted it to Ugandan shillings. So our asset, let me say the machinery is now reported at 1 billion in the financials. We do not have to restate it because we reported it at its historical cost. Since these are reported or recorded, let me use the word recognized, are recognized at historical cost. Of course, at the date of acquisition. So for non-monetary assets like PPE, don't translate. However, when it comes to non-monetary assets that are measured at fair value, we have to exchange, we have to translate. For non-monetary assets recognized, let me use the word measured at fair value. For these ones, we have to translate, we have to retranslate them at the date when the fair value is measured. Assuming that you have an investment property, okay, at the start of the year, you translate it from USD to Ghanaian shillings, and that property you are measuring it at fair value, because IS40 allows us to use fair value or cost model. If you choose fair value, then at the reporting date, you must retranslate. You need to know, is there an exchange gain or an exchange loss? So here we should translate the asset. Okay, translate the asset using the exchange rate, prevailing at the date when the fair value is obtained. Okay, very critical points that we should be able to remember when it comes to translation of such transactions. Okay, so Daniel, is that clear? Yes, please.
It's clear.
Okay, since it is clear, Daniel, once you, for monetary, we have to restate. For non-monetary measured at cost, okay, we do not translate. Whereas for non-monetary measured at fair value, we translate. That means that as we translate, there is going to be some exchange differences, either a gain or a loss. So the question is, how do we treat the exchange differences? I'm sure we all know that we take always this to statement of profit or loss. Is that true? Yes.
What do you mean by non-monetary assets? An example. I'm a bit confused.
PPE.
Monetary. What about monetary?
You join the net, any monies, any trade receivables, trade payables, those are monetary. Is it clear now? This one? If I have dollars, is that monetary? If I have receivables,
Monetary.
if I have payables, so yeah, those are monetary. You get it, eh? So for monetary ones, restate at closing rate. For non-monetary, let me add here a statement, measured at cost. Measured at cost. Do not restate. Whereas for non-monetary, measured at fair value, of course, restate, because the cost keeps on changing. Okay, once we translate, we expect exchange differences. And dear students, for exchange differences, when we are translating from foreign currency to our functional currency, those differences are taken to profit or loss as and when they arise. As and when they arise. So in case in a question, the examiner tells you that these guys were taking the exchange differences to OCI, you can challenge it. Once you are translating from one foreign currency to your functional currency in the normal operations, then the difference should go to profit or loss. However, if fair value changes for a non-monetary asset measured at fair value are recognized in OCI, e.g. PPE, IS 40, if you have e.g. property, plant and equipment held at under valuation model, true, because for IS 40 it goes profit or loss, no problem. When it comes to fair value changes that go to OCI, like in IS 16, revaluation model, then the exchange difference should also go to OCI. This is the same requirement with IS 12. Do you remember that requirement? Ivan, have you come across it? IS 12 also says, if the deferred tax is obtained, okay, for a transaction whose changes go to OCI, even the resulting changes in deferred tax should go to OCI. It is the same point here. Yes, we know that once we are translating currencies from foreign currencies to our functional currency, the gains or losses should be taken to profit or loss. But for those specific transactions where the gains or losses go to OCI, even the exchange differences should go to OCI. Any precious, is that clear? Is Precious on call? Ivan, is that clear?
Ivan, now, I request you to cut a little bit. My network was on and off.
Okay. When it comes to
It's like besides the P and L, now this one below.
yes, if I'll give an example of property of IS 16, okay, and we've selected revaluation model, okay, the gains or losses, where do they go? To OCI. So even any foreign, even assuming that you have land, okay, that you are keeping for an unknown reason, an unknown purpose, right? You've not yet determined it, okay? Or you're holding it for capital accumulation. Those are all factors of IS 40, not so?
Yes.
So if you hold that land at fair value, wait, no. I'm now discussing IS 40, sorry. I want to give you for IAS 16. If you've elected to measure that land, okay, it's there for own use, or it is land and building, you are occupying it as your offices, right? So since it is your offices, it is owner use, therefore that is IAS 16. And you selected revaluation model where you revalue it, okay, at appropriate periods, which is the requirement of IAS 16. Any fair value gain or any revaluation surplus is going to go to OCI, not so?
Yes.
So since the revaluation surplus goes to OCI, when it comes to translating this asset at the end of the year, because it is measured at fair value, then the exchange gain coming from that translation should also go to OCI, because that's where even the fair value changes went. Is that okay?
Yes, that is okay.
Unlike for IAS 40, because for IAS 40, where do the gains go?
You go to P and L.
Then even the exchange difference should also go to P and L. Is that clear now?
It is clear.
Okay. We have that basic question. Can you just help me answer it very fast? Ivan, you can take us through it very fast, and then we move to something else.
Required. Show the accounting treatment at the end of the transaction and at the year end.
Perfect.
It's a nearest.
Mm.
An entity whose functional currency is dollar sold goods to a customer on credit. Yeah? Had 100,000 Antons from 1st November to X1. The Anton is a foreign currency exchange. Foreign currency. Exchange rates were.
Okay, 1 second. Yes.
Okay, this was okay. Exchange rates were 1st November to X1. That is 1 for 55.8.
When was the transaction date?
1st November to X1.
And we said for transaction date, what do we use? Do we use spot rate? Do we use average rate, or we use closing rate?
Closing rate.
Ah. Okay, continue.
Now they say there is this day 31st December to X1, $1 for 6.3. Then the next year end is 31st December to X1. Year end is 31st December to X1. The required show the accounting treatment at the date of the transaction, at the date of the transaction, and at the year end. So at the date of transaction, we shall use 1 to 5.8. Then at the year end, we shall use 1 to 6.3.
So here at the date of transaction, we use spot rate.
Yes.
At reporting date, we use. Hope we all remember the definitions of the two. Perfect. So what is going to be the double entry? Let us just have the double entry at transaction date. What should these guys report? How should they record this? Okay. These guys sold what? They sold goods, not so? On credit. Is that okay? On credit. Perfect. Is goods on credit leading us to a monetary item?
Yes.
Which is a trade receivable, not so?
Yes.
And since it's a monetary item, then we should translate it at year end, right?
Yes.
Okay. So here we should debit what? This guy should debit a receivable, not so? Is that true?
Yes.
The debit trade receivable is just normal. Don't look at the foreign currency. Just look at the normal double entry. You recognize a trade receivable and then you credit to what? Is it revenue? Or sales? When you bring in inventory, then you're going to bring in cost of sales. Not so? This is sales and trade receivable, not so? If it was cash, it would have been debit cash, credit to your sales. True? Ivan, are you getting it?
Yes, that is true.
Okay. Then we convert. Then we convert this. Remember, let me do this. We have to translate this because the functional currency is a dollar. So we cannot include Antons in the financial statements. These guys are entitled to, these are Antons. I can put here the rate we are going to use. Then here they have dollars, which is their functional currency. So they are entitled to 100,000 Antons. And we are saying, since this is the transaction date, we use the spot rate. Spot rate is the rate at the date of the transaction, which is 5.8. So what is going to be the dollars now? Who can get for me the figure? Do we divide or multiply? We divide. In case it is confusing you, just move to your Excel file. You say $1. The other side you put 5.8. What is going to be this X when I have 100? If it is confusing you, just do that. Then you cross multiply. You realize that here is going to be 100 divided by 5.8. How much do you get? Okay, 17. Let me first create some space here. So I'm just doing that for those who are not familiar with the translation. Okay, so here you get 17,241. Okay. And then you're going to credit the same amount, right? Of course, this is going to be 100, same exchange rate. So you credit 17.241. Okay, that is all. That is at the transaction date. Then at the reporting date, we are saying this is a monetary item, trade receivable, at reporting date. At reporting date. What's the name of the company? Okay, it's just an entity. The item, okay, you can say trade receivable. Trade receivable is a monetary item. Okay, as such, it has to be retranslated. Using the closing rate. Okay, so here I'm not going to waste time. We have debit, trade what? This time round, how much is going to be the value now? What is the trade receivable? The trade receivable is now worth $. How much is it? It is 100 Antons divided by the rate is 6.3. How much do you get?
15,873.
So you get 6. You get 15. 873. Is this lower or higher than the opening rate, the opening value?
This one is low.
So are we having an exchange gain or exchange loss?
Exchange loss.
As such, there is an exchange loss. So how much?
Okay. Let me just get the difference here. Of 1367.
Okay, so this is 7,241, and you're saying it is
1,367.
Okay, 1,367. And where does this go?
Statement of profit or loss.
Statement of profit or loss, because the trade receivable is a normal item, no other OCI complications. It's not for non-monetary assets. Okay, which is charged? Which is charged to statement of profit or loss. Perfect. Have we understood the concept of exchange rate at a basic level?
Yes. So even meaning if it was a payable, it would be right? It would be in this case, it would be again.
If it was, yes, assuming that you are supposed to pay 17, but you're paying 15, that is a gain. Because you're paying less. Okay, so that is all about functional currency. Now let us look at presentation currency. Presentation currency is that currency that we use when presenting our financial statements. Is that okay? I'll give you an example. We have operations in Congo. We have operations in Congo.
Excuse me.
Yes, please.
You have some typing.
I have a typing somewhere. I'll check it out. Okay, let me confirm. Which one?
Supposed to be 17. Two for my language.
What is the reporting date value?
Reporting date.
It will be the same thing. You've got it.
Yeah.
And I'm
It's supposed to be 168.
1368. Okay. I've not put here negative because once I use the word exchange loss, it is not a negative, right?
Okay.
Perfect. Let us now discuss presentation currencies. I've told you the presentation currency, very simple. What is the currency in which your financial statements are presented? You might find that, you see, IAS 21 allows us to use any presentation currency. My functional currency can be Ugandan shillings. Then I decide to present my financial statements in dollars. There's that liberty. You do not have any restriction. So, presentation currency is the currency in which the financial statements are presented. An entity may present its financial statements in any currency. Ivan.
Yes.
Can you use any functional currency that you wish?
Oh, I think there are rules and criteria to follow.
For functional currency, we follow these rules. Those 4 rules, sales, forces of demand and supply, currency of raising funds, okay, and then in which your receipts are retained. For functional currency, it is very strict. When it comes to presentation currency, you can use any currency. Now the issue is, you have moved from translating your transactions from foreign currencies to your functional currency. Now you have another problem. You have a functional currency that is UGX, but you selected your presentation currency as dollars. Are you supposed to translate also?
Yes, you're supposed.
You have to. Perfect. What do we have to do now? That's the second problem. The results, that is a statement of profit or loss, of course. This is financial performance. The results and financial position of an entity whose functional currency is not the currency of a hyperinflationary economy are translated into a different presentation currency as follows. Basically, just know, once you have a different presentation currency, then you have to translate from the functional to the presentation. We start with the statement of financial position, where we have assets and liabilities. The standard says you must translate your assets and liabilities at each reporting date using the closing rate. Is this now grasped, Ivan?
Yes.
When it comes to moving from functional currency to presentation currency, we use closing rate. Then it comes to income and expenses. This is at year end, of course. We only translate at year end from functional currency to presentation currency. When it comes to incomes and expenses, we use the spot rate. What is the spot rate? That is the actual exchange rate at the date of transaction. We use, for statement of profit or loss, we use the spot rate. However, if there are if there is any volatility, then you use average rate. Then we use average rate. Then we use average rate. Then is that grasped also?
Yes, it is anyway. What I'm wondering,
Yes.
how do you volatility of the rate?
Now with the Ugandan shilling. Yes.
What circumstances will
Okay.
volatility of the
For exam purposes, the examiner will mention it. Okay? That the USD exchange rate is very volatile. However, what does it mean to be volatile? It means that it keeps fluctuating. Today, it is at 3,600. Tomorrow, it is at 4,000. The other day, it's at 4,500. Then the other day, it comes back to 3,500. Once the force of demand and supply and the other international factors, including the demand of oil, even the demand of the UGX or the international market, once they are volatile, even the exchange rate also becomes volatile. Now, those are factors that can affect or that can cause that can cause exchange rate volatility. You will cover it in AFM. For SBR purposes, we just have to know that once the exchange rate is volatile, that is keeps fluctuating, then we use the average rate. The examiner will mention it. If you want to know which factors can lead an exchange rate to be volatile, then for AFM, Advanced Financial Management, there is a unit that will handle that. Then is that okay?
yes, it is.
Now, when it comes to translation from functional currency to presentation currency, the exchange differences go to OCI under something we call a translation reserve. Ivan,
Yes.
we are saying we create now a new line item called a translation reserve. So if you have an exchange gain, it has to go to a translation reserve in other components of equity. That is for the statement of financial position. And then for the statement of profit or loss and OCI, it goes to OCI. Is it okay?
Yes, it is okay.
This statement is very important to the question I'm going to discuss today. Once we do translation from functional currency to a presentation currency, then the gains or losses should go to OCI. And for us to move them from OCI to the statement of financial position, we create a reserve called a translation reserve as an item under other components of equity. Precious, is that clear?
Yes, it's clear.
Okay. So once I talk about translation reserve, don't ask me where am I getting the statement from. It is a requirement by the standard that any translation between a functional currency and a presentation currency should go to OCI, not profit or loss, and then moving it to statement of financial position, we create a new line item called a translation reserve. So we've discussed the basics regarding IS 21. That is, translating from foreign currencies to functional currency. The requirements are known. Then after the end of the year, once we have a different presentation currency, we must translate the assets, liabilities, the incomes and expenses. The standard still provides what we use and where we take the exchange differences. Now let us look at what if, yes,
Excuse me, sir.
yes, please.
Regarding the average rate, there is a question I made, and they didn't mention about the volatility.
Yes.
However, they had the opening rate was used for the beginning transaction, and then the closing rates at the end. Then the transactions that occurred in between were calculated using the average rate.
That is true. Because do you know at what point these transactions occurred? Do you really know?
No.
And I think we're going to find it also in the foreign operations when it comes down to consolidation. But that is the argument. Since now for those other transactions whose dates are not known, maybe some expenses over the period, they give you expenses within the period, right? Then you don't know you don't know the spot rate. What do you have to do? You take the average rate. Okay. And trust me, even the question I'm going to discuss, that is the same concept that we are going to find. Now we have foreign operations. You have a subsidiary in Congo. You operate in Uganda, use Ugandan shillings. Then your subsidiary in Congo makes use of the USD. Their presentation currency is USD. Your presentation currency is UGX. But you have to consolidate, of course. Or you have to use equity accounting if it is an associate. How do we deal with it? For foreign operation, an entity that is a subsidiary, associate, joint arrangement, or branch of a reporting entity, the activities of which are based or conducted in a country or currency other than those of the reporting period. That's the definition of a foreign operation. Basically, you have a different currency, your subsidiary has a different currency. Once that happens, then that is a foreign operation. How do you translate this? Another important requirement. How do you translate this? The foreign operation determines its own functional currency and prepares its financial statements in that currency. Yes. Our entity in Congo, they determine their functional currency. They even choose. Since we said with the presentation currency, it is a choice. So the functional currency can be the same as the presentation currency. So our entity in Congo, our subsidiary, will have its own functional currency. I'll use the USD. And then the presentation currency is also USD. Where different from the parent's functional currency, the financial statements needs to be translated before consolidation. Of course, you can't add UGX to USD. You must convert from USD to UGX, then you consolidate UGX and UGX. Very simple concept. The financial statements are translated into the presentation currency of the reporting entity using the presentation currency rules outlined above and adopted for foreign operations. Basic. Determining a foreign operations foreign currency. Well, even in this question, we are going to discuss it won't be really very different from what we covered up there. These guys have different currencies. Those guys operate in Congo. They have the Congo currency, okay, which should be franc, if I'm not mistaken. They have the USD. They also operate with us in UGX. Then they have to determine what is their functional currency. The following additional factors are considered in determining the functional currency of a foreign operation and whether its functional currency is that of a reporting entity. Perfect. There is going to be a problem. Yes, you've considered the sales prices, the selling prices of that foreign operation. You've considered their labor and material. You have considered the additional one was, what is the additional factor? The way they raise their funds. Now the issue is, what is the relationship between the foreign subsidiary and the parent company, the reporting company? We have to look at these factors. Whether the activities of the foreign operation are carried out as an extension of the reporting entity rather than being carried out with a significant degree of autonomy. If our subsidiary in Congo is autonomous, they make their decisions, then they can have a different foreign currency, I mean functional currency. However, if it is just an extension of our operations, then the study says we are likely to have the same functional currency. Ivan, is this clear? Ivan, are you on call?
Yes, I'm on call.
And is that statement clear?
Try to digest it, maybe try to maybe.
Okay. We want to know, is the functional currency of the subsidiary in Congo the same as the functional currency of the subsidiary in Uganda? Okay. If
yes,
the first point is, look at the autonomous level. If these guys are autonomous, okay, then they are likely to have a different functional currency. However, if we have some level of command in the activities, that is, they are not autonomous, then our functional currency is likely to be the same. Let us first read the next points. An example of the former is when the foreign operation only sells goods imported from the reporting entity and remits the proceeds. That is an extension. We have a branch in Congo, we send them goods, they sell, then they send us the money. That means that it is just an extension of our parent company in Uganda. Then at what point can we know that it is autonomous? An example of the latter is when the operation accumulates cash and other monetary items, incurs expenses, generates income, and arranges borrowings, all substantial in its local currency. This shows that this entity is autonomous. It is carrying out its own activities, both operational and financing activities. Is it now clear, Ivan?
yes, it is clear.
So we assess the level of autonomy. Then 2, whether transactions with the reporting entity are high or a low proportion of the foreign operations activities. After looking at the level of autonomy, now we want to see, do we have, let me say, out of 100% of the activities, 95% is between us and them? Then the indicator is we have the same functional currency. But if our level of interaction is low, then these guys have a different functional currency. Does it make sense, Ivan?
Yes, it makes sense.
Then the third point, whether cash flows from activities of the foreign operation directly affect the cash flows of the reporting entity and are readily available for remittance to it. This means that we are really depending on the operations of these guys, right? In the scenario, we are going to be looking out for these points: level of autonomy, number of transactions with the foreign subsidiary. Then do we depend on their cash flows? Such that if these guys don't remit, we don't survive. If that is true, then we have the same functional currency. But if we don't depend on their cash flows, then they have a different foreign functional currency. Then lastly, whether cash flows from activities of the foreign operation are sufficient to service existing and normally expected debt obligations without funds being made available by the reporting entity. This is also important. We need to know what we are discussing here, and what you will find in the exam is for you to ascertain if the functional currency of the parent is the same as the functional currency of the subsidiary. So if these guys in Congo have enough money to service their debts, we do not have to send them money from Uganda to Congo. Then these guys are independent, and therefore they have a different functional currency. That's why when it comes to foreign operations, in addition to the other first 4 points we discussed of selling prices, of direct labor and material, of raising funds, of retaining, those 4 points, you have to add on these 4 to see if indeed the foreign subsidiary has a different functional currency from that of the parent. Is it now clear, Daniel? After all these points being passed, now we have to exchange problems. If the foreign subsidiary is autonomous, these guys, we have literally no transaction with them. These guys, they can service their debts. Then they have a different functional currency from ours. What is the problem? We have to translate. In case that is true, then we must translate. How do we translate? That's the next question. Where a foreign operation has a different functional currency to the parent, the financial statements of the operation must be translated prior to consolidation. We all expect this, and we support it. Okay. So, Ivan,
Yes.
in addition to the first 4 points, please add on to this, because we have to assess them also in our foreign subsidiary to see if it has a different functional currency. Is that okay? Okay. So, what is the problem? These guys have different transactional. They have different functional currencies. What are we supposed to do? We have to translate these things. Okay. Now, since we are translating financial statements now, Ivan, are we translating transactions? We are translating financial statements. So let us look at how do we translate items under the statement of financial position. That's what we are saying. In practical terms, the following approach is used when translating the financial statements of a foreign subsidiary for exam purposes. And our first point is statement of financial position. Statement of financial position. So now we are converting from the USD, which is the functional presentation currency of the subsidiary in Congo. We want to convert it to UGX, which is our presentation currency. Under the statement of financial position, we have assets and liabilities. So all assets and liabilities, we should use, I think let me just use a table. We should use the closing rate. And Ivan, what is the closing rate?
It's the closing rate.
It has a definition as when we discussed. Isn't it the exchange? Yes. Mm-hmm.
Is that rate? Is it at the reporting date?
Yes, the rate at the reporting date. If it's 31st December, then the rate given on 31st December is the closing rate. So for all assets and liabilities, under statement of financial position, we use the closing rate. You can abbreviate it as CR. Then what is remaining? Share capital, right? We have share capital. When it comes to share capital and any pre-acquisition reserves, those who are good at consolidation, you know that under working note number 2, there are some cases where we have to remove some reserves that were accumulated before the acquisition. Do you remember that, Ivan? This one here.
Yes.
Pre-acquisition. Okay, let me finish. Pre-acquisition reserves. Can I give you an example? Ivan?
So you can give us an example.
This entity reports financial year ended 31st December 2x8. You bought shares in July 2x8, meaning that from 1st January to 30th June, these guys accumulated some profits, right?
Yes.
But the examiner will only give you the profits at the year end. Meaning that from 1st January to 30th June, those profits accumulated are called pre-acquisition profits. So those are pre-acquisition reserves, okay? So when it comes to share capital and the pre-acquisition reserves, we use the historical rate. Historical. Do you know what the historical rate is? This is the existing rate at the date when you gain control. Okay? The rate at the date when control is gained. Ivan, is that okay?
Yes, that is okay.
Now we have another problem. We have the post-acquisition reserves. Those are the reserves after when you've gotten what? Control, not so?
Yes.
So, post-acquisition reserves. Those are the profits after you gained control. This can be 1, profit for the year, which is true. Profit for the year. We use the actual or average rate. Of course, we know when we can use average rate, right? When there's volatility or fluctuations. Here we use actual or average rate, which we can abbreviate as AR for each year. This will be given. When it comes to dividends, for it we use also actual rate, actual rate at the date of payment. Of course, by the time when they are paying those dividends, once the subsidiary in Congo pays dividends, we are going to use if they declare 20,000 USD as dividends, then the date they've declared those dividends, the exchange rate at that point is what we use to translate from USD to UGX. Okay. Perfect. Of course, once you do these exchange rates, once you exchange these items, what is the resulting impact, Ivan? Once there's an exchange process?
We have either a gain or loss.
Of course, perfect. You have a gain or loss. Okay. Do I have to give you how this can be done? Of course, no. Are you seeing what I did here? Okay. Let me just draw it. Are you seeing this? We shall have our assets in functional accounts of the subsidiary. Then we have the exchange rate. After exchanging it, we have the presentation currency. Let me just give you this as a summary. Let me just give you this summary, chap. Maybe it can help you still grasp this and how to apply it in the questions. Let me do this to make it easier. Okay, so I'm going to remove this. Okay, so what I'm going to do, let me just draw a statement of financial position. I can have the line item here. You can have the functional currency, the exchange rate to use, then the presentation currency, so that I'm able to consolidate, to add line by line. Okay, so here I can have the functional currency of the subsidiary, functional currency. Here I can have the exchange rate. Then here I can have the presentation, which now I can use to consolidate. So when it comes to assets, for assets, we said that here, of course, you have, let me say, USD. I'm just giving an example. Okay. So I need to use the closing rate. Then I can be able to get the UGX. Ivan, is it making sense?
Yes, it is making sense.
Please don't take this CR to be credit. It is closing rate, yeah?
Yes.
Then you'll have your total what? Here you have your total. Here you have your total dollars. Here you have your total dollars. I can call these my total assets. I'm just trying to mimic the statement of financial position, total assets. Now what comes up next is the share capital. Share capital. And for share capital, we said what do we use?
Historical.
We use the historical rate. That is the rate when we gain control. Then we get the UGX. After share capital, we can look at share premium. Share premium. Of course, you have here in dollars. You want to, what are we going to use?
Actual.
Share capital and share premium.
We use the historical.
We are going to use the historical still. So this is historical. We get UGX. What else comes under? We can also have pre-acquisition reserves, right? Pre-acquisition retained earnings. Pre-acquisition retained earnings. Those are the profits that I told you about. This is going to be dollar. We use historical rate to get our UGX. Now next we shall come, we have the post-acquisition reserves, including profit for the year, including dividends. Okay, so here we can have now the, let me do this. Now you will have the post-acquisition reserves, and we've said these ones can include, let me just do this. These ones can include the profit for the year. Of course, we know that this has to go to retained earnings. Profit for the year, we shall have it in USD. We said, what are we going to use for post-acquisition reserves?
Actual.
We use the actual rate. We get our UGX. Then we come to dividends. Of course, with dividends, it will also be in USD, but we want to convert it to UGX, so we also use actual rate of payment, actual rate at date of payment, then you can get our UGX. Okay, what is remaining? We can have, of course, we have share capital, pre-acquisition retained earnings, post-acquisition. Then at the end of the year, we are going to have our liabilities. But remember, we have some translations. So I'll leave a space here. So we have liabilities. It is in USD. Which one are we going to use?
Closing rate.
We use the closing rate for all liabilities. After that, we shall get our UGX. Meaning that down here, you have your total what? You have the total equity and liabilities. It will give you this figure here. Of course, now this is going to come to that. But remember, because of the translation, you should have some exchange difference. So an exchange difference is going to be a balancing figure here. Exchange. Because what is going to be here, this figure here, shall not be equal to this figure. So we have what we call the exchange difference on net assets. Exchange differences on net assets. And this is going to be a balancing figure. Ivan, is that a question or someone wants to join? Ivan?
Yes.
Is that a question or someone wants to join?
I'm not really sure about that.
Okay, I've had some warning. Okay, now that is how we treat the statement of financial position. I hope it is clear. Yes.
I'm confused on the balancing figure. So the balancing figure, what are we comparing with? Because here we have come translating.
Yes.
So
it is going to come out with a question. Right now you notice that these things are not balancing, but because of the exchange differences, the balance sheet will not be balancing. So you create an exchange difference. Yes. With an example, it will come out. Okay. When it comes to statement of profit or loss, purely we use the average rate. If there are fluctuations, or the actual rate of the transaction once it is known. So our first part was statement of financial position. We've seen how we translate it and the rates to use. Now we are going to look at the statement of profit or loss and OCI. For items, statement of profit, or loss, and other comprehensive income. Very, very easy. Use the actual rate for the rate of transaction, or we use the average rate as an estimation. I'm sure Sharon,
Yes, sir.
your query was on items in the statement of profit or loss. True or false?
Sure.
All items are translated. All items are translated using the actual rate, which is the rate at the date of transaction, or the average rate as an approximation. That is for the statement of profit or loss and other comprehensive. So for all items, please pay attention to this. In the question I'm going to discuss for you, maybe the examiner will say these guys use the different rate. Maybe they use the closing rate. Ivan, what do you have to say? There is a problem there, not so?
Yes.
Once they are dealing with an item of profit or loss and they use a different exchange rate, then you identify that issue. And therefore it calls for some correction, not so?
Yes.
Okay, let us now look at a statement of profit or loss, how it looks like. Of course, we have revenue, we have cost of sales and all that. So probably I can draw 3 of them. Okay, so we have here, insert here, we can take it to the right. So here we can have our rate, here we can have our presentation, currency, then this is going to be the functional currency. Oops, not enough. Let me put on the extreme left. On the left, I have my functional currency. Okay, so here I have revenue. I think someone wants to join. That bell is for joining. Okay. So we have revenue. The functional currency is of course going to be dollar. I'm taking dollar for our subsidiary in Congo. What do? We less cost of sales, not so? Cost of sales in dollars. What do we get here? Gross profit. Ivan, I should be working with you.
Yes.
Okay. Here we get gross profit in dollars. What do we got now? Is it other expenses or admin expenses, right? I can call them operating expenses. Operating expenses, they're going to be in dollars. What am I going to get here? Ivan? Is it profit before tax? In dollars. Then I will get my income tax expense for the year. I remove it from the profit before tax. Then I get my profit for the year. Profit after tax, what you call profit for the year. It is going to be, I should use dollars. It is going to be dollars. Okay, then we shall have OCI. Shall have our OCI, other comprehensive income. It should be also in dollars. Then I can get my total comprehensive income. Total comprehensive. My total comprehensive income, which is profit for the year plus OCI. This one is going to be also in dollars. Ivan, which rate should I put here?
Average rate.
We are converting each one of them at average rate. So I'll just do this. All of it, average rate. Then I'll get this in UGX. UGX, ILS UGX. I get UGX. I get UGX. I get UGX. ILS UGX. I get UGX. I add UGX. I get UGX. As simple as that. Now, just like in translation from presentation currency to functional currency, when it comes to foreign operations, also these foreign gains, all the exchange differences, all of them go to OCI. Okay, let us have exchange differences. All exchange differences, okay, on translation of foreign operations, that is subsidiary, associate, are recognized in other comprehensive income. Other comprehensive income. Okay. Ivan, is that clear? Ivan, is it clear? Practice time. Is Ivan on call?
Excuse me, sir.
Yes, please.
I wanted to ask regarding the statement of financial position.
I'm not getting your question.
Yes, that is clear.
There is a statement earlier that said request a
It is clear.
for the translation results. I was wondering at what point do you put the translation results?
Okay.
Is it the exchange difference somewhere? Is that exchange difference or net assets? That okay.
Can we first have an example? I'm sure your question is going to be answered with an example. In fact, with the practice question, I'll show you where the translation reserve is supposed to be put.
Okay, sir.
That is under other components of equity in the statement of financial position. Okay. In the question, I'm going to do the... Yes, please.
Yeah, I can hear you. It's just because of the network. I can hear you.
It is okay then.
Just maybe when I'm speaking, you can't hear, but I can hear you.
Okay. But Sharon, have you got the issue? The translation... Yes, the transaction reserve is going to come out very well when I discuss the full consolidation number, where we have a pre-populated spreadsheet. I will show you how the transaction reserve comes in. Currently, I'm just trying to show you the basic concepts, so that when it comes to the full consolidation, you know where things will be coming from. Okay, let us have an example here. Let us have an example. Okay. Okay, we shall see these ones later on. Let us have this question. So the exchange rates are, let me set them, let me have a table here. So we have 1st September, 1st September 2x5. This is crowns. Okay, wait 1 second. This is crowns dollar, and it is 2.5. Then on 31st December 2x5, this one is 2.0. Then our average rate for the year, average rate for 2x5 is 2.25. Okay, so you'll be reading through up there as I finish it up. So that one's okay. This one is at 12. Let me also put this at 12. This at 12. So now we have other information coming up. Other information coming up. Okay. So this is all required. We should run through this very fast. Okay. So the question is, explain the correct accounting treatment of goodwill, showing any relevant calculations and any adjustments necessary to correct the consolidated financial statements. Probably these guys have a problem with their calculation of goodwill. So the examiner wants us to correct it. Let us read through. H, a public limited company whose functional currency is dollar. This is very important. The functional currency of the parent is USD. So we highlight it. Has recently purchased a foreign subsidiary R. The functional currency of R is crown, meaning that these guys assessed all the conditions and they realized that the functional currency is a crown. So the parent and the subsidiary have different functional currencies. So you cannot consolidate without translation. H purchased 80% of the ordinary share capital of R on 1st September 2025 for 80 million crowns. Is this the date when these guys gained control? Yes, it is. We have the control percentage 80% and the date 1st September, meaning that this information is important. This information is important. This information is important. Okay. The carrying amount of the net assets of Robin at the date was 90 million crowns. The carrying amount of the net assets of R at that date was 90 million crowns. So we have the net assets given. Share capital 5MC, share premium 12, other reserves 73. That's okay. The fair value of the net assets at that date was 100 M. Ivan. Ivan. I want someone to talk to. Okay, Daniel, are you on call? No one is willing to talk. Can I end the class? Can I end the class? You guys are tired?
I'm on board.
At the year end of 31st December 2005, the goodwill was tested for impairment, and this review indicated that it had been impaired by 1.8 million. So there is also an impairment on goodwill. There is also an impairment on goodwill. There is also an impairment on goodwill. Yes, please. It is okay, Ivan. Let me just proceed.
I can hear you. I can hear you.
Okay, it's fine. H elected to measure NCI in Robin at fair value at the date of acquisition. So these guys are using fair value method to measure their NCI. So we expect them to give us that value or to give us the share price. The fair value of NCI in R on 1st September 2005 was 20 million. So we have the fair value of the NCI. The management of Hood is unsure, the management of H is unsure how to account for the goodwill, so has measured it at the exchange rate at 1st September 2005 in the consolidated financial statements. Wow. Okay. My question is, are you guys, are you able to get me? Daniel, can you hear me?
Yes, I can hear you. Yes, sir.
Is goodwill an asset?
Yes, it is.
Which exchange rate should we use?
Closing rate.
Now, what these guys are using what?
They are using the historical rate.
So are they not wrong? So this question wants you to find the goodwill. After getting the goodwill, exchange it to the currency, okay? Exchange it at year end to a currency similar to that of the parent. Similar to that of the parent. So our task here is one, to calculate the goodwill in crowns. After finding it, then we translate it to dollars using the closing rate as the standard requires us to do. Okay. Now let me give you the solution. We are not going to translate all of these things. We have to calculate the goodwill. Okay. The goodwill at acquisition. After getting it, remember there is some impairment. So the goodwill at acquisition should be translated at the acquisition date. But at year end, since there is some impairment, we have to retranslate it using the closing rate. But let me just show you how we are supposed to calculate. I can just maybe tell you this. The goodwill arising on acquisition of foreign subsidiaries needs, or I can say is calculated. It is calculated, okay, in the functional currency of the subsidiary, and initially translated into the functional, I'm giving this just for notes purposes, into the functional currency, of the parent, okay, at the spot rate, at the date of control, However, at year end, this goodwill needs to be retranslated at the closing rate. I want someone to talk to. Daniel. Is that statement very clear? We first calculate the goodwill at the date of acquisition. After getting the goodwill, translate it to the functional currency of the parent using the exchange rate at the date when control was gained, which is the acquisition date. After that, we have to retranslate this goodwill at the year end. But now that translation involves using the closing rate. Okay, so now let's calculate our goodwill. Daniel, can you tell me what is the template for getting goodwill? Okay, perfect. So you're telling me that I should look at, maybe I have very many boxes. Can I remove some? Let me remove like 2. So you're saying that I get this young man, remove this. So I'm going to look at the consideration. Can we use the word purchase? The purchase consideration. And in this case, these guys paid money, right? They only have cash. How much did they pay?
86.
Okay. Okay. So we are going to have here, our currency is crown. And we can say crown in millions. Okay, can I say million crowns? Will it be confusing? Million crowns. Okay, so these guys paid cash. Of 86. What else do we do in goodwill calculation? Yes, fair value of NCI at acquisition. And did they give it to us?
Yes, it should be.
That yellow statement. How much is it? 20 million. Perfect. So I always tell students we can get our total cost of investment, which is the same as total consideration. How much is it?
106.
106. What else do we do? Okay, where's the fair value of? Okay. Okay, true. Let me first move down. So we are saying we need to less fair value of net assets of the subsidiary And is it working out number 2?
Yes.
Okay. But did they give us, look at this, did they give us the net asset values?
Yes. They look into facts.
What is that?
Total as 100.
So it is 100. Just take that 100.
Yes.
Okay. But do you realize that there is some fair value adjustment? Have you seen it? Because the carrying amount was 90. Okay. So it is 100.
Yes.
It is 100. Don't disturb yourself. So we are removing 100. How much do we get as our goodwill?
6 million.
It is 6 million. So this is our goodwill at what?
Acquisition.
But the standard says we must convert this goodwill at acquisition, not so? So we need the rate. Then we need the dollars in million. So this goodwill at acquisition, which rate are we going to use?
We're going to use
Perfect, which is what?
2.5.
Perfect. Very good. So we take 2.5 here. My question is, are we dividing or multiplying problems? Are we? Yes. Why? What does this mean? 2.5 crowns? Yes.
1 crown is equal to
No.
$5.
No. It means
Show equals to
so it should be 1 crown.
Division.
How are you? Okay, the question is, how do you get the division? Not everyone can see it. Can you help someone understand it?
Okay, so $1
Mm.
is equal to 2.5 crowns.
Okay, saying $1 equals 2.5 crowns.
Which would mean that X dollar
Perfect.
is equal to
Our
the
6.
6 million crowns that we have.
So we end up dividing.
Cross multiply, so 2.5x
Mhm.
is equal to 6,
Okay.
and then that would be 6 divided by 2.5.
So 2.5 crowns. In fact, it should be X. 2.5x
Yes.
crowns.
Yes, 2.5x,
It is equal to
6 crown, $6.
is equal to $6 crown. Okay. So the argument is what I wanted us to get, that Daniel, this crowns to dollar means that 2.5 crowns is equal to $1. Daniel, you get it?
Yes, sir.
Because if you change it that 1 crown equals $2.5, then you get it wrong. All right, so we can remove this. We all accept that we are going to be dividing. Okay, so what do we get here? Can you get for me the figure? How much you get here?
2.4.
2.4. Perfect. But they told us that what happened to the goodwill?
It was impaired.
The goodwill was impaired by how much?
1.8 million crowns.
Yes, let me hope we are all seeing this. Impaired by 1.8 million crowns. So we come and put here our impairment loss. The argument is dear students, we are measuring NCI using fair value. Therefore, the impairment is also impairment for the goodwill, because this is a full goodwill. This is a full goodwill. So we have impairment loss. Impairment loss. It is 1.8. So we are lessing our 6 by 1.8. How much do we get? 4.2. Perfect. We have two types of financial statements: profit or loss, financial position. Where does impairment go? Profit. So which rate do we use here? Perfect. So we should go and pick the average rate, because impairment loss is a profit or loss item. We use the average rate, which is 2.5. So we come and convert that impairment, 2.25. How much do you get? Hello? How much do you get?
0.8.
0.8. Good. So this is our goodwill at what? This is our goodwill at reporting date, not so? At reporting date. It is 4.2. We said we must retranslate goodwill at reporting date, right?
Yes.
Using which rate?
The closing rate.
We use the closing rate, which is how much? 2.0, not so?
Yes.
Okay, so we have here 2.0. Can you get for me the figure? Now we are translating it. 2.0. How much is it? 2.1. Okay. But let me ask you, when you get 2.4, you remove 0.8, how much do you get?
$1.6.
You get 1.6. But here the final figure is 2. Is it there again? So there is an exchange difference, not so? Daniel. Now, are you getting how the exchange difference has come up with an example? Because if you get 2.4 minus 0.8, you don't get 2.1. So how do we fill this gap? Okay, so here we are getting, I can put it besides here, we are getting 1.6, not so? So we are saying we have 1.6 plus some exchange difference we don't know. It gives us 2.1. So what is our x? 0.5. So we come and put it here as the exchange difference. 0.5. And that is always, this is always the balancing figure. The same way we've calculated here, this exchange difference will also come up when you are translating the full statement of financial position. It will come up. Is that okay, dear students?
Yes.
Okay, let us go back to the question. Okay. Okay. Did they give us the fair value, the management, so as measured at exchange rate? Okay. Look at this. These guys measured their goodwill using one exchange rate on 1st September. So what do you think is the goodwill they're having in their books? Who can give me that figure? Yes? Who can get for me that figure? We have 4.2. We divide by 2.5. Okay, let me check.
1.68.
I see I have 1.68. I think in this question, I left out a statement. These guys had recorded their goodwill at 2.4. Yes. But at least now we have at least the concept. The other adjustments, the errors they have made, assuming that yes, the examiner has given us they had recorded their goodwill at 2.4, yet it should be 2.4, yet it should be 2.1. Yet it should be at 2.1. It implies that these guys are supposed to make some adjustments. They are supposed to make some adjustments. But this is what I wanted to bring out. I tried to edit the question. What I wanted to bring out is how we translate goodwill at acquisition, then at reporting date, and also how we treat impairment loss. Also how we treat impairment loss. Okay, I think now we have reached the gist. Let me give you one more example. You try out at your end, then we go to the actual consolidation question. Is that okay, Daniel?
Yes, sir.
Okay. Otherwise, I just leave it out and we go to the main question. Okay. Let's see, is it really very, very critical? No, let me just leave this one out. Let me discuss a question on ethics. Assuming that this foreign subsidiary comes in question 2, ethics. Where should we put emphasis? What are the likely ethical issues that should come up? Okay. So we can discuss ethics. The examiner says, foreign currency translation adds additional complexity to financial statements. We all agree. Especially determining those exchange rates to use, then the functional currency, presentation currency, then foreign operations. Very complex. It also makes the financial statements less transparent because the translation itself is not visible to the user of the financial statements. That is true. The problem is the choice of exchange rate and the need for consistent application of the translation principles are areas where manipulation of the financial statements could arise. These are points that you should just keep at the back of your mind. Why? Foreign currency translation is a complex topic, and therefore it is prone to management manipulation. Why? They have a liberty to choose which exchange rate to use. Then the consistency itself can also bring the problems. Similarly, the choice of presentation currency which is a free choice under IS 21, could affect the image the financial statements give, depending on which currency is chosen and the volatility of exchange rates with that currency. So that is the ethics note that the examiner gives. Why we think it can be prone to ethical dilemmas. And when you are reading through the scenarios, make sure that you pay attention to which exchange rate the guys have used. How did they find the presentation currency? Practice time. Let me give you a question that involves ethics. That involves question 2. In fact, I'm going to use this to even show you how we answer question 2. Numbers. Okay. Okay. Ivan, are you now on call?
Yes, I am on call.
Okay. So let me give you this question that involves question 2. In fact, I can use it to show you how we can interpret question 2. Numbers. Okay. Question 2, numbers on ethics. Remember, question 2 is ethics with accounting standards. So you have to be strong in accounting standards for you to be able to crack the ethics within that question. Okay, so here we have 12. Ivan. Ivan, can you hear me? Precious, can you hear me?
Yes.
Ivan, are you able to speak?
Yes,
Okay, take us through this question.
I can hear you. I don't know if you can hear me.
Okay, take us through that question.
Yeah. I can hear you.
Yes, can you take us through this question? Then we move to the standard number, please. Precious. I think Ivan has network problems. Precious. Precious has left. Sharon. Sharon, can you hear me?
Yes, sir.
Can you take us through that question?
It's like mine. I don't know if you can hear me.
Okay. The question says, discuss why the proposed treatment of the exchange differences by the directors is not in compliance with IFRS, explaining any ethical issues which may arise. Ranking on 60% of JP, the directors of ranking are thinking of acquiring further foreign investment in the near future, but the entity currently lacks sufficient cash to exploit such opportunities. They would prefer to raise finance from the equity issue, as ranking already has significant loans within non-current liabilities, and they do not wish to increase ranking's gearing any further. They are therefore keen to maximize the balance of the group retained earnings in order to attract the maximum level of investment possible. One proposal is that they will sell 5% of the equity interest in JKIN during 286. This will improve the cash position, but will enable ranking to maintain control over trade flow. In addition, the directors believe that the shares can be sold profitably to boost the retained earnings of ranking and the group. The directors intend to transfer the relevant proportion of the exchange differences on translation of the subsidiary to group retained earnings, knowing that this is contrary to accounting standards.
Okay. What I'm going to do, Sharon, at least the examiner has concluded very well. They want to take the translations to retained earnings. Where are they supposed to go? Is it other components of equity?
Yes.
And transaction reserves. So these guys at where are these guys taking it? So of course, which is wrong. Okay. And also you cannot take full differences to group retained earnings. These have to be shared between the NCI and what? And the parent. You get it? So when it comes to those exchange differences, they should be divided between the parent and the NCI. When we go back to this question here, we all know that this goodwill should be shared between the parent and NCI. Similarly, what should be this 2.1? Similarly, this 0.5 should also be divided between the parent and the NCI, depending on their ratios. But because these guys are manipulating the financial statements, they want to take full amount to group retained earnings. So that is also wrong. For me to run through this very fast, let me just give you the answers. We read through them. Then I give you a chance to look at the full consolidation number I have. Please allow me just show you how the answer was drafted and the requirements or the key learnings, so that we can find time to run through the other standard question I've prepared. I'm going to share it on the group so you don't have to get worried. Okay, so here we are. I'm going to be emphasizing the key points. Maybe I can first read through. R owns 60% of J. The directors are thinking of acquiring further foreign investments in the near future, but the entity currently lacks sufficient cash to exploit such opportunities. So they have no money. That is the first thing. Oh, and if you have no money, but you want to invest, you need to go for loans. They would prefer to raise finance from an equity issue, as Arakin already has significant loans within non-current liabilities, and they don't wish to increase Arakin's gearing any further. These guys, they have no money. They have enough loans on their portfolio, and most probably there is a covenant. That is why they are very cautious with raising finance through debt, because once the gearing ratio goes past a given level, okay, they might breach a loan covenant. So they are deciding to go for an equity issue. They are therefore keen to maximize the balance on the group retained earnings in order to attract the maximum level of investment possible. Remember, I told you when I was teaching ethics that as a professional accountant, you should protect the interest of the key users of financial statements, who are the providers of funds, investors, and creditors, by giving them material information that can assist them in making decisions. So because of self-interest, because of greed, these guys want to maximize their group retained earnings so that they can be able to raise more money on their issue. This is explaining why they are taking the foreign exchange differences to retained earnings. Are you getting it?
Yes, sir.
So because of their self-interest, they want to maximize the amount they will get from the issue. They are going to manipulate now the retained earnings by taking their exchange differences, which should go to transaction reserve. And also, they should take only a portion for the parent, not the full value. Problems. One proposal is that they may sell 5% of equity interest in Jenkins during 2x6. This will improve the cash position, but will enable ARA to maintain control over Jenkins. They are selling off 5%, but they are still retaining control. In addition, the directors believe that the shares can be sold profitably to boost the retained earnings of Rakin and of the group. Imagine these guys. They are saying we sell the shares, the amount we have received from there, we include it as part of our retained earnings. But remember, retained earnings should be a representation of earnings from the operational activities, not so. What the examiner is trying to show you is these guys are playing with the financial statements so that they can appear profitable. Then, of course, the last one is very direct. The directors intend to transfer the relevant portion of the exchange difference on translation of subsidiaries to group retained earnings, which is wrong. So let us see how we interpreted it in terms of the answer. If J were to sell the shares profitably, a gain would arise in its individual financial statements, which would boost retained earnings. However, if only 5% of the equity shares in ARA were sold, it would still hold 55% of equity, and presumably control would not be lost. This statement here, the examiner still gave you the head zone that these guys are selling 5%, but they will retain their control here. Where is it? One proposal, this one here. They will sell 5% out of the 60%. They are selling 5%, but they will still remain within control. So examiner is saying, you manipulating that statement and putting it down, you get a point. ISB views this as an equity transaction. Transactions with owners in their own capacity as owners. What does it mean? We all know, I think we looked at a question, I discussed it with you, where we had the disposal when control is retained. And there we had to calculate NCI. There is no profit. It is NCI, then also calculate an adjustment in equity. This means that the relevant proportion of the exchange differences should be redistributed or reattributed to the NCI rather than to the retained earnings, and not reclassified to profit or loss because control has not been lost. This means that the relevant proportion of the exchange differences should be reattributed to non-controlling interest. Yes, it should go to the NCI guys and not to retained earnings. We all agree. And not to retained earnings. And not reclassified to profit or loss because control has not been lost. The directors appear to be motivated by their desire to maximize the balance on the group retained earnings. This is observed. It would appear that the directors' actions are unethical by overstating the group's interest in ARA at the expense of the non-controlling interest. You see, the examiner is not even talking about those hard, heavy words. But once you see something that is contrary to the accounting standard, for you to say it is unethical, because indeed it is not proper, they are going against the requirements of the standard. At some point, the scenarios can be very tough. Now, what you need is for you to see what something that is not right, and you comment about it. Then you get your marks. Okay. The purpose of financial statements is to present a fair representation of the company's financial position, financial performance, and cash flows. And if the financial statements are deliberately falsified, then this would be deemed unethical. What was the question? Discuss why the proposed treatment of the exchange differences by the directors is not in compliance with the international accounting standards. Explaining any ethical issues which may arise. So these manipulations are unethical. Accountants have a social and ethical responsibility to issue financial statements which do not mislead the public. And for you can say, which do not mislead the users of the financial statements. Just making that statement can earn you a mark. In fact, with the ethics questions, dear students, you identify the bad things. You identify the bad things within the scenario. If you cannot remember our self-interest, professional behavior, and all, identify what is wrong in the scenario, then comment about it. And give general comments that should be reflecting a professional accountant. The director's intended action appears to be in direct conflict with the code by deliberately overstating the parent company's ownership in the group in order to maximize. Stakeholders are becoming increasingly reactive to the ethical stance of an entity. Deliberate falsification would potentially harm the reputation of J and could lead to severe long-term disadvantages in the market. The director's intended action will therefore not be in the best interest of the stakeholders. There can be no justification for deliberate falsification of an entity's financial statements. I've just run through this question, dear students. Allow me share with you the full question I want us to discuss. At least we run through it, we brainstorm, and I let you guys go and finish up the answer. Is that okay, Daniel? Daniel, is that okay? Okay, I'm sharing the question in the group. I'm sharing the Excel file. At least this one is on I is 21, and it's my interest today. The ethics part was just an addition. So let me share with you this. And the time is really moving so fast, and the fatigue is almost setting in. But at least you can push for the next 30 minutes. At least you can push for the next 30 minutes. Okay. Give me 1 second. I need to share something.